I argued that silver is going to explode, but you can maintain a spread chart where you divide an ounce of silver into an ounce of gold, express it as a percent. A lot of people do it the other way. It's a ratio chart, but we do it ounce of silver to gold. And right now, silver price is about 1.2% of the price of gold. Okay. If you go back and examine what happened in those two prior bull markets at the phase where silver went ballistic, we'd been going up for a couple of years, 75, 76, 77, 78, 80 finally. In the last 6 months of that move, silver went quadrupled in price. It had already been in a bull. It wasn't like it wasn't a bull then. It just said, I'm gone. Okay. And in 2010, September of 2010, 6 months before silver reached 50 again, in April 2011, it doubled in a half. When we got bearish in January of 2000, .com top, we had many doubters among our subscribers because it wouldn't go down. In fact, it made a higher high in March of 2000 after we said, get out. And it made a new high monthly close in August of 2000. But they were like, small double digits above the level we said, be gone from this category. Okay. But it took a whole year of this teasing firmness, not a lot of firmness. So like the S&P right now is 10% above its prior high of January. Some indexes made their high in late last year, price highs, and some of them are now back below that. For instance, the financial sectors, it's dropped back below what had been its prior high that it broke out of in sympathy with the S&P move. Something's going on there. You got to watch the sectors because they ain't doing what the S&P is doing, meaning very limited symbols. So it's an arduous process. Same happened in 2007. You hit a high in it was, I think, March, April of 2007 at 1550 S&P. That happened to be the price high of the year 2000, 1550, a couple points above there. And they sold into it in 2007, dropped it hard into the summer. And we were arguing, you're in a topping process. And sure enough, it came back up one more time in September and October. Fed cut rates, first time in a while. And the market partied. Oh boy. And blew through the double top at 1550, 2000 high, 2007 high. And got up to 1575, which was actually right in the middle of our target zone, 1550 to 1600 that we put out a year before. And they broke out. So if you're looking at a price chart, you had a triple top breakout. That was the top. Okay. So don't be teased by a market going through a new high. Momentum of the S&P has broken major structure. And the rally since then to a new high on momentum, it's up under, well below the high we made early this year. And underneath a broken trend structure that goes back to 2022. So momentum says, no, you're no good. Price says, look at me, I'm a champion. I trust the momentum. I think we're in a topping process.
Price charts often tell an incomplete story during turning points. Momentum, however, reveals when a trend has already fractured beneath the surface. In the current cycle, the S&P 500's price may project confidence, but long-term momentum has broken its multi-year structure, similar to the breakdown seen in late 1999 and early 2007. While headlines celebrate new highs, momentum is signaling deterioration, not strength. The rally off early year lows hasn't rebuilt the momentum structure, suggesting the market's engine is running on fumes. When price and momentum contradict each other, experienced analysts trust momentum because it reveals stress before price catches up.
I think it's in trouble. I think it's not in speedy trouble. And frankly, the correlation, for example, between the dollar index and moves in gold is very pathetic. It's not good. In other words, it's not inverse. People think, oh, if the dollar goes up, gold goes down. No, it's not true. In fact, if you go back to the bear low in gold, 2015, gold price was 1,050. Okay. If you go back to where dollar index was then, which happened to be a high, was at 98 area, dollar index. Right now, dollar index has been either side of 98 for about 5 months. Okay, so it's where it was 10 years ago, dollar index, and yet gold is where? $4,000. Okay, it was 1,500. So you would have missed the entire gold bull move had you looked at the dollar index and said, I want to buy gold only if the dollar weakens. What happened in March of this year on the dollar, it slipped down from like 110 to 104. And in March, we said we're bearish. It's since dropped under 100 and is flip-flopped back above 100, back down, back up, going nowhere effectively since the April low. So people say, oh, the dollar's up. No, since April low, you can draw a sideways line. It's doing nothing. It's just spinning its wheels. And we think it is momentum broken, and highly likely the next major move is down, and it's already in process starting back in March. But again, we don't focus too much on it because it doesn't really impact the core markets that we're looking at. People assume there's a correlation, but it's not true.
Many investors still assume gold moves strictly opposite the U.S. dollar, but recent history shows the relationship is weak and inconsistent. When gold bottomed near $1,050 in 2015, the dollar index was near 98, almost exactly where it wandered throughout 2024 to 2025. Yet gold climbed dramatically while the dollar remained flat. The dollar's sideways drift in recent months is not a meaningful signal for precious metal investors. Gold responds more reliably to real rates, liquidity cycles, and market stress, not day-to-day currency fluctuations. With long-term momentum strengthening and central banks continuing record purchases, gold's secular uptrend remains firmly intact.
The Bloomberg Commodity Index, now I know a year ago everybody said, oh, inflation's terrible. Well, commodity inflation isn't, okay? We had a run in the Bloomberg from a low, a bear market low that occurred in 2020, mid-year. It had gone down from 2011 to 2020. And its old highs, if you look at Bloomberg, go back to 2008 peak, it was 238. A 2011 peak, it was 170. You know where it is right now? 107. Okay, so it's half the price of its prior bull market peaks. We did have a sharp run up from that low in summer of last year, 2020, and it ran for a year and a half up until the war began in Ukraine. That's when it basically peaked 3 weeks later, the commodity complex. It didn't run up because of the war. It stopped when the war began, actually, and then pulled back to 100 area. Again, its low was under 60 in 2020. So it had about a 50% pullback from that first surge where it went from under 60 to 140 and then pulled back to 100. 2.5 years, it's gone dead sideways, the commodity complex. Almost no volatility, no dimension in price. So it's steady. It was just saying, I'm not going back to that low again. I'm too cheap, okay? Again, 107 compared to the 2008 high at 238. Okay. We look at each commodity within the Bloomberg, and some of them have broken out, some haven't, but the Bloomberg itself broke out last month via our annual momentum metrics that say, okay, the first leg we saw in 2022, then the pullback, we're now going to start a second leg.
The Bloomberg Commodity Index has spent nearly 3 years moving sideways after its sharp rebound from the 2020 lows. Despite global inflation headlines, real commodity prices remain historically cheap. The index is still far below its peaks in 2008 and 2011. This prolonged basing behavior often precedes major multi-year reversals. Recent momentum signals now suggest the second leg of the commodities cycle is beginning, supported by improving trends across metals, agriculture, and energy. Even oil, currently a laggard, shows signs of building long-term support. If commodities rise while equities weaken, the long-suppressed commodity-to-equity ratio could finally reverse upward.
Okay. And we see evidence within the complex when we examine like the energy sector, the grains, or the base metals, that, they're all ready to participate. Oil happens to be a laggard this time. It's not a leader. It was tended to lead that last rally, but this time it's going to be a laggard, but still join in, I think. So, I think the Bloomberg commodity complex is ready to turn up again. But when you put it in a real long-term context, measure it versus the S&P, like the spread chart I sent you, you can see that where the Bloomberg was beating the S&P up through the 2008 period, and then it made a topping process. You can see it on the spread chart, treated as just a price chart. And when it broke down, it collapsed in value to levels that are almost unbelievable in terms of the relative value collapse we've seen in, call it, real world assets compared to paper bubble assets. Okay. So even if you just look at that chart and you believe in the notion buy low as an investor, think long term, buy low, don't buy high, don't chase things. It's saying, hey, watch me because I'm cheap. And it's not really been going much lower since 2020, marginally. But so Bloomberg really ceased its decline 5 years ago and has been waffling around in a basing type pattern relative to the S&P. It's not going to take much if the Bloomberg starts to move up now, as we argue it's likely to, and if the S&P starts to weaken, then that spread's going to break out again. And when it does, I'm going to bet that you could invest in the commodity category, grain area, stocks related to agriculture, oil area, stocks related to oil, et cetera, base metal miners. And over the next 10 years, you'll do quite well and beat the heck out of the stock market. And so it looks like a major investment type situation. I don't think it's going to beat gold. It's certainly not silver in terms of percent gain, but it's a place to be. And you need to watch it closely because it won't take much signal to generate that shift in the asset categories.
Oil prices remain near the lower edge of their multi-year range, yet repeatedly refuse to break sustainably lower. Long-term momentum suggests that a monthly close near the mid-$60 could trigger a technical breakout, signaling a new bullish phase. While geopolitical headlines often cause short-lived price spikes, the real catalysts tend to be structural: tightening supply, underinvestment, and rising global demand. When viewed relative to the S&P 500, oil and other tangible assets look exceptionally undervalued. If the broader commodity complex continues turning up, energy markets are likely to follow, even if they lag in the initial stages.
When you look at the historic price levels of oil, go back a decade, 15 years, where you are now is low. It's very low, okay?
Yes.
So, compare it to the S&P, compare it to itself, it's cheap, okay? The technicals of oil, we measure the momentum factors, not just the price. 60 is at the low end of the range of the last handful of years, okay? It's been in the 50s, so forth. But, basically, that's been cheap for years now. It just doesn't want to go down from there and sustain. It keeps trying to rally and then fails. However, now, if during this quarter you see a monthly close on the front month contract of crude, WTI, at 68, now admittedly we're 60, 61 area, it's the way to go. But a couple months ago when that Iran event occurred, they shot it up into the upper 70s. Lesson there is don't buy war news. It never works, okay? But if you get to 68 during this quarter, that momentum, long-term momentum of crude oil says, I'm coming out of here. Okay, now, when we get into next quarter, okay, less than 2 months away now, that number is going to drop even further, probably down to 65 area. And so if you get oil up to that level, on a price chart, it doesn't say a lot, but on momentum, it says, now, I'm out of here. And at that point, I don't know what the reason would be. I'm not trying to argue fundamentals, but all the expectations of, Trump's going to keep it down and all this stuff will go out the window. And I suspect by the Bloomberg breaking out now is oil tends to move with the Bloomberg. You can treat it as a separate entity, but if the Bloomberg's going up, you can bet oil, it may be lagged this time, but I bet it goes up with it. Now, the one thing I forgot to talk about was the silver-gold relationship.
Okay. I
argued that silver is going to explode, but you can maintain a spread chart where you divide an ounce of silver into an ounce of gold, express it as a percent. A lot of people do it the other way. It's a ratio chart, but we do it ounce of silver into gold. And right now, silver price is about 1.2% of the price of gold. Okay. If you go back and examine what happened in those two prior bull markets at the phase where silver went ballistic, we had been going up for a couple of years, 75, 76, 77, 78, 80 finally. In the last 6 months of that move, silver went quadrupled in price. It had already been in a bull. It wasn't like it wasn't a bull then. It just said, I'm gone. Okay. And in 2010, September of 2010, 6 months before silver reached 50 again, in April 2011, it doubled in half.
Throughout the last two major precious metal bull markets, silver lagged gold for years, until a breakout in the silver to gold spread signaled the start of its most explosive phase. In both 1979 to 80 and 2010-11, silver didn't merely rise, it multiplied, doubling or even quadrupling in months. Today, silver is again historically cheap relative to gold, representing just about 1.2% of gold's price. A push through the 1.31% spread level would signal that silver is ready to outperform dramatically. Technical momentum is already pressing against this threshold. When the breakout comes, history suggests silver's acceleration may be far more powerful than gold's.
In 6 months, okay. You want to quadruple silver from where it is now, you're talking 200, okay? You want to double in half, well, you're talking, 125, whatever, okay. What was a signal back then that event was going to occur? Because when you looked at the price charts, they were already going up. So it wasn't a big deal that they just went up faster, okay? So the price charts weren't telling you. You'd already been in a bull trend. The spread. Divide the ounce of silver into an ounce of gold and plot it month to month. And sure enough, back then, even while silver had been going up for a couple of years along with gold, 76, 77, 78, 79, okay, it was going up less. And therefore the spread was deteriorating. Silver was underperforming the advance in gold, so it looked negative on a spread chart. It was still making money, but it wasn't as much as gold. The spread built a structure. And it ran up to a level, pulled back, ran up to another level a year later, pulled back. And when it came through that level, the spread broke out. And that told you silver's now going to beat gold. That's what set off the fuse. Same thing happened in 2010. You'd had a depressed action by silver to gold. It built a spread dynamic that you could see, draw a ruler across it. And in September 2010, you broke out, and that's when the price of silver went ape. We have a very similar situation on the chart I sent you. There's two charts there. One is the spread chart at the top, and you can see there's a red horizontal line on it. Comes to just above 1.3%. Again, we're right now at 1.2%. You ever get a monthly close above 1.31%? Actually, it's where those precise two prior highs were going back 4 years. That breaks out and it says, I'm out of here. And you're still at very cheap historic values of silver to gold. Heck, 20 of the past 50 years, silver's at least been 2% price of gold. Well, heck, if you go from 1.2 to 2, that's a huge multiple. I mean, silver is almost doubling in value to gold. And in bull markets, going back 50 years, during the 79-80 move and the 2010-11 surge, silver reached well over 3%. So from 1.2 to 3, well, wow, okay. Huge potential multiple. The key is to break that spread out. Now, the chart below the spread, pardon me for getting scientific here, is a momentum of the spread, where we measure the spread in relation, oscillated versus its 10-month average. And you have the same picture. Dual highs, you want to break through them. Well, heck, it's September, we closed on the line and back up ever so slightly into October. It will take a hair's breadth to break out the momentum above its ceiling. And when it does, you can bet that the spread will follow. So those are the metrics we're watching that tell us the clock has begun. The clock for the go into a new reality. So that's what we're focused on now. Gold's already outpaced the stock market, except for the S&P, and it's ready to do that. But when silver breaks out versus gold, it's telling you it just began. You haven't gone ape yet. Everybody thinks it's gone crazy. No, it hasn't. It hasn't even begun. So that's a technical we're looking at.